The September morning arrived in Dallas with a kind of crystalline clarity that suggested permanence. 23 floors above the sprawling Texas metropolis, the executive conference room at Blockbuster's corporate headquarters radiated the quiet confidence of market dominance. Mahogany panels reflected the soft glow of recessed lighting, while floor-to-ceiling windows framed a cityscape that stretched toward horizons where strip malls and suburban developments housed thousands of the company's blue and yellow storefronts. John Antioco adjusted his position at the head of the polished conference table, surrounded by the senior management team that had guided Blockbuster through its most prosperous years. The company's stock price hovered near historic highs, supported by quarterly earnings reports that consistently exceeded analyst expectations. Revenue approached $4 billion annually, generated through a network of 9,000 stores, spanning 43 countries across 6 continents. The business model had achieved something approaching mathematical perfection. Customers drove to physical locations, browsed inventory arranged according to sophisticated demographic analysis, selected entertainment content, and returned it within predetermined timeframes. Late fees alone generated approximately $800 million each year, representing pure profit on transactions that required no additional inventory investment, manufacturing costs, or complex operational overhead. At the opposite end of the conference table sat 2 men whose company represented everything Blockbuster was not. Reed Hastings, chief executive of a California startup called Netflix, wore the understated attire of Silicon Valley entrepreneurship. Beside him, Mark Randolph, the company's co-founder, arranged presentation materials with the methodical precision of someone who understood this meeting might determine his company's survival. Netflix operated a mail-order DVD rental service that served fewer than 300,000 subscribers from a single warehouse in California. The company had reported cumulative losses exceeding $50 million since its 1997 founding, burning through investor capital at rates that made traditional retail executives uncomfortable. Their business model eliminated late fees entirely, absorbed postal delivery costs into monthly subscription pricing, and relied on algorithmic recommendation systems to guide customer choices. The contrast between these organizations reflected fundamental disagreements about consumer behavior, technology adoption, and the future of entertainment distribution. Blockbuster had built its empire on the assumption that customers valued immediate gratification over convenience, that browsing physical inventory created superior discovery experiences, and that late fees represented acceptable friction in exchange for flexible return policies. Netflix operated from opposing premises. Their research suggested customers increasingly prioritized convenience over immediacy, that personalized recommendations could replace physical browsing, and that subscription models would eventually prove more profitable than transaction-based pricing. These assumptions remained largely theoretical, supported by limited market data from a customer base too small to validate broader consumer trends. The meeting had been arranged through weeks of persistent calls from Netflix's corporate development team to Blockbuster's strategic planning department. Hastings had positioned the session as a partnership discussion, though internal documents revealed more desperate circumstances. Netflix needed either acquisition or substantial investment to survive the economic downturn that had devastated dot-com companies throughout 2000. Wall Street had grown skeptical of internet-based retail ventures following spectacular failures among once promising startups. The Nasdaq Composite Index had declined more than 60% from its March peak, eliminating hundreds of billions in market capitalization and forcing investors to reassess the viability of companies that prioritize growth over profitability. Netflix fit the profile of vulnerable internet ventures, high cash burn rates, unproven unit economics, and business models dependent on consumer behavior changes that might never materialize. Antioco had agreed to the meeting partly from curiosity and partly from strategic prudence. Blockbuster's competitive intelligence teams monitored emerging threats across multiple categories, from discount retailers to technology companies to international entertainment conglomerates. Netflix appeared on these radar screens as a minor irritant rather than existential threat, But prudent management required periodic evaluation of potential partnerships or acquisitions that might strengthen market position. The Netflix executives began their presentation by acknowledging their precarious financial situation. Hastings spoke candidly about cash flow challenges, investor pressure, and the need for strategic partnership to achieve sustainable operations. This transparency was calculated to establish credibility, while positioning Blockbuster as a potential savior rather than predator in acquisition negotiations. The partnership proposal centered on operational integration that would preserve both companies' core competencies. Blockbuster would acquire Netflix for $50 million, gaining access to their mail-order logistics, recommendation technology, and growing subscriber base. Netflix leadership would join Blockbuster's management team, bringing expertise in digital operations, customer data analysis, and subscription business models. Under this arrangement, Blockbuster could offer customers multiple access channels, immediate gratification through physical stores, and convenient home delivery through mail service. The companies would cross-promote their services, allowing store customers to discover Netflix's mail option, while Netflix subscribers could access new releases immediately through Blockbuster locations. This hybrid approach would capture both traditional rental customers and emerging convenience-focused segments. Randolph presented market research indicating gradual shifts in consumer preferences toward subscription-based entertainment consumption. Their data showed monthly subscribers demonstrated higher lifetime value than transaction-based customers, generated more predictable revenue streams, and exhibited greater loyalty during economic downturns. The elimination of late fees, initially viewed as revenue sacrifice, actually increased customer satisfaction and reduced churn rates. The Netflix team emphasized their technological capabilities, developed through 3 years of focused investment in recommendation algorithms, logistics optimization, and customer data analysis. Their warehouse automation systems could process thousands of orders daily with minimal human intervention. Recommendation engines analyzed viewing patterns to suggest titles, creating personalized experiences that increased customer engagement and reduced customer acquisition costs. These technological assets represented intellectual property that would require competitors years to replicate independently. The recommendation system utilized collaborative filtering techniques that improved accuracy as subscriber bases expanded, creating network effects that strengthened competitive moats. Logistics software optimized inventory placement, shipping routes, and return processing to minimize costs while maximizing delivery speed. Hastings outlined how the combined entity would position itself for inevitable industry transitions toward digital distribution. DVD adoption rates suggested consumers increasingly embraced higher quality viewing experiences in home environments. Broadband internet penetration, while still limited, was accelerating among affluent demographics that represented Blockbuster's most profitable customer segments. Eventually, digital streaming would replace physical media entirely, requiring distribution capabilities that Netflix was already developing. The financial terms seemed reasonable within the context of both companies' circumstances. $50 million represented less than 2% of Blockbuster's annual revenue, easily absorbed without material impact on quarterly earnings or capital allocation priorities. Netflix shareholders would receive Blockbuster stock, providing liquidity while maintaining upside participation in the combined entity's future performance. Integration challenges appeared manageable through phased implementation approaches. Netflix would continue operating their mail service independently, while Blockbuster evaluated optimal convergence strategies. Cross-marketing initiatives could begin immediately, testing customer response to hybrid service offerings without disrupting existing operations. Technology integration would proceed gradually, minimizing disruption risks while capturing synergy opportunities. Antioco listened to the presentation with the measured attention of an executive accustomed to evaluating strategic proposals. His management team took notes, asked clarifying questions, and exchanged glances that suggested skepticism about core assumptions underlying the Netflix value proposition. The Blockbuster leadership had built their careers on understanding consumer behavior through decades of physical retail experience. Their expertise centered on location analysis, inventory management, and customer transaction optimization within traditional retail frameworks. Foot traffic patterns, demographic analysis, and geographic market penetration represented quantifiable success metrics. Revenue per square foot, inventory turnover rates, and customer acquisition costs through advertising and promotional activities provided clear performance indicators. The Netflix model operated on fundamentally different assumptions about customer behavior, technology adoption, and market evolution. Mail order logistics replaced location advantages with warehouse efficiency. Recommendation algorithms substituted for in-store browsing experiences. Subscription pricing eliminated transaction-based revenue optimization in favor of customer lifetime value maximization. Late fee revenue particularly complicated strategic evaluation of any Netflix partnership. These charges generated approximately 20% of Blockbuster's total revenue, with profit margins approaching 90%. Customers had accepted late fees as industry standard practice, allowing Blockbuster to maintain competitive pricing on rental transactions while capturing additional revenue from forgetful or busy customers. Eliminating late fees would require fundamental business model restructuring. Monthly subscription pricing would need to generate equivalent revenue per customer, potentially requiring price increases that could drive customers to competitors like Hollywood Video, Movie Gallery, or regional chains. The transition risks seemed substantial relative to uncertain benefits from mail order operations serving a tiny customer base. International expansion priorities also influenced strategic calculations. Blockbuster was investing heavily in European, Asian, and Latin American markets, where American entertainment content commanded premium pricing. These international operations required physical presence to navigate local regulations, cultural preferences, and competitive dynamics. Mail order services assumed postal infrastructure and internet adoption that remained limited in many target markets. The competitive landscape included established players with deeper resources and broader market reach than Netflix. Amazon had launched DVD sales and rental services, leveraging their logistics capabilities and customer relationships. Walmart offered DVD sales at prices competitive with rental fees, potentially undermining the entire rental market. Cable and satellite providers were developing video-on-demand services that delivered content directly to homes without physical media. Technology trends presented additional uncertainties. Digital video recording devices allowed customers to capture content from television broadcasts, reducing rental demand. Broadband internet speeds were increasing, though slowly, potentially enabling direct digital distribution that would bypass both physical stores and mail order services. The timing and pace of these transitions remained unpredictable, making investment decisions extremely difficult. The Netflix executives concluded their presentation with financial projections showing subscriber growth trajectories and eventual profitability through scale economics. Their models assumed that convenience would ultimately override customer habits, developed through decades of physical rental experiences. They acknowledged the speculative nature of these assumptions, while emphasizing competitive risks of allowing other companies to establish digital distribution advantages. The meeting proceeded through detailed discussions about technology integration challenges, customer data sharing protocols, and operational coordination requirements. Netflix operated from a centralized California facility serving subscribers nationwide, while Blockbuster managed inventory across thousands of locations with varying local demand patterns. Combining these systems would require significant capital investment and operational disruption during a period of economic uncertainty. Marketing integration presented additional complexities. Blockbuster's brand emphasized immediate access to the latest entertainment content through convenient neighborhood locations. Netflix promoted unlimited monthly access to extensive catalogs without late fee penalties. These value propositions targeted different customer segments with potentially conflicting expectations about service delivery and pricing structures. Staffing considerations reflected deeper cultural differences between traditional retail and technology companies. Blockbuster employed thousands of store associates trained in customer service, inventory management, and transaction processing. Netflix operated with minimal customer service infrastructure, relying on automated systems and self-service capabilities to minimize operational costs. Integrating these approaches would require extensive training, system development, and process re-engineering. Supply chain relationships with movie studios presented another integration challenge. Blockbuster negotiated volume purchase agreements for new releases, often guaranteeing minimum purchase quantities in exchange for favorable pricing and exclusive availability windows. Netflix operated on different terms that emphasized catalog depth over new release timing, acquiring content at lower costs but with delayed availability. Antioco thanked the Netflix team for their comprehensive presentation and indicated that Blockbuster would evaluate the proposal through established strategic review processes. The meeting concluded with standard corporate courtesies, business card exchanges, and commitments to follow-up communications. The Netflix executives gathered their presentation materials and departed through the same elevator that had carried their hopes upward 2 hours earlier. The weeks following the Dallas meeting revealed Blockbuster's strategic priorities through resource allocation decisions and public statements. Internal discussions focused on immediate competitive threats from existing physical rental chains rather than speculative digital disruption scenarios. The company continued aggressive international expansion, opening hundreds of stores in European markets where American entertainment content commanded premium pricing. Capital allocation priorities emphasized proven growth strategies, new store development, inventory expansion, and promotional partnerships with major film studios. The company invested in point-of-sale technology upgrades, loyalty program enhancements, and demographic analysis systems that optimized inventory placement across different market segments. These initiatives generated measurable returns through increased customer traffic and higher transaction values. Netflix, meanwhile, faced mounting financial pressure. As investor confidence in internet companies remained depressed, the company reduced marketing expenditures, delayed technology upgrades, and explored additional partnership opportunities with other entertainment industry players. Subscriber growth slowed as economic recession limited consumer discretionary spending on non-essential services like mail-order entertainment. The rejection of Netflix's partnership proposal reflected established corporate decision-making processes that prioritized quantifiable returns over speculative opportunities. Blockbuster's management applied proven analytical frameworks developed through decades of retail experience to evaluate an opportunity that required different assessment criteria. The decision appeared rational within existing strategic parameters. Blockbuster's quarterly earnings reports through 2001 and 2002 validated their strategic approach through consistent revenue growth and margin expansion. New store openings contributed predictable revenue increases, while existing locations generated higher per-customer transaction values through improved inventory management and promotional strategies. Late fee revenue continued expanding as customers retained movies longer during economic uncertainty. The physical rental model appeared vindicated by market conditions that favored established, profitable business operations over speculative internet ventures. Consumer behavior patterns remained largely unchanged, with customers continuing to visit stores for entertainment content despite increasing internet adoption for other retail categories. Netflix struggled through this period with customer acquisition challenges, operational efficiency problems, and persistent losses that tested investor patience. The company reduced expansion plans, eliminated unprofitable service offerings, and focused resources on core competencies: recommendation technology, logistics optimization, and customer retention strategies. However, technology infrastructure developments during 2002 and 2003 began revealing limitations of purely physical distribution networks. Broadband internet adoption accelerated among affluent consumer segments, creating opportunities for digital content delivery that bypassed traditional retail channels entirely. DVD manufacturing costs declined, making mail-order economics more viable for companies willing to absorb initial losses for long-term market positioning. The competitive landscape shifted gradually as new players entered entertainment distribution markets. Amazon expanded their DVD services, leveraging logistics capabilities and customer relationships developed through book sales. Apple introduced digital music distribution through iTunes, demonstrating consumer acceptance of internet-based content delivery. Cable companies invested in video-on-demand infrastructure that provided instant access to extensive movie libraries. Netflix achieved operational profitability in 2003 through subscriber growth and operational optimization. Their customer base exceeded 1 million subscribers, generating monthly recurring revenue that provided predictable cash flow for continued investment in technology and content acquisition. The company's initial public offering in May 2002 had raised capital that enabled accelerated growth initiatives despite continued market skepticism about internet companies. The strategic implications of Blockbuster's rejected partnership proposal became apparent through comparative market performance metrics. Netflix's market capitalization exceeded $2 billion by 2004, 40 times the valuation Blockbuster had dismissed 4 years earlier. Their subscriber base grew to over 2 million customers, generating annual revenues approaching $700 million. Blockbuster attempted to develop competing mail order services through internal development programs and selective acquisitions. However, these initiatives required rebuilding technological infrastructure, operational expertise, and customer relationships that Netflix had accumulated through years of focused investment. The company's extensive physical store network, once a competitive advantage, became a cost burden that limited pricing flexibility and operational agility. Consumer behavior evolution validated many of Netflix's original assumptions about convenience preferences and subscription model acceptance. Monthly subscription services gained traction across multiple entertainment categories, from music streaming to video gaming platforms. The elimination of late fees, once considered economically impossible, became a standard customer expectation that traditional rental companies struggled to accommodate without fundamental business model restructuring. The financial mathematics of the missed opportunity reflected broader patterns in technology industry transitions where established companies underestimated disruptive innovations. $50 million represented approximately 1% of Blockbuster's market capitalization in 2000. Yet acquiring Netflix would have positioned the combined entity to control both traditional and emerging distribution channels during a fundamental industry transformation. Market forces continued their relentless progression through the decade, creating new competitive dynamics while destroying established advantages according to patterns that remained unpredictable even in retrospect. The September 2000 meeting in Dallas had lasted 2 hours and cost $50 million. The consequences unfolded over 20 years, as Netflix evolved into one of the world's largest entertainment companies, while Blockbuster declared bankruptcy in 2010. Its 9,000 stores reduced to a single location that operated more as curiosity than business. The story concluded without resolution or moral clarity, as corporate decisions often do, leaving only the mathematics of missed opportunity and the persistent question of whether different choices might have produced different outcomes in an industry where consumer preferences, technology capabilities, and competitive dynamics continued evolving in directions that defied prediction or control.